Good evening, everyone. First of all, welcome to this amazing refresher course on Ind AS. I think we're having amazing knowledge learning session through this entire course. So before we take it ahead, let's first play the ICI motto. I request to please play the ICI motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्द्वैत 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 एतद्द्वैत.
Thank you so much, everyone. So beginning our today's session, I think just to quickly give you a brief, I'm CA Rajesh, the elected regional council member at WRC. And thank you so much, Chintan sir, my colleague in the council, to entirely frame this entire refresher course on Ind AS. I think this works exactly well with our theme of this year, which is leap towards achievement, excellence, and development. I think that's whole plan that we're going to have these a lot of refresher courses across the various topics, and I think a topic on Ind AS, having this entire course done, which is extremely essential. Thanks to all the participants. I request Chintan sir to please give the opening address.
Thank you so much, my dear council colleague in region, CA Rajesh Pankhania, the faculty of the session, CA Rajesh Mody, and the coordinator, CA Aniza Kaji. Welcome all of you to the third day of this particular course. We are trying to design the course in such a fashion. The first day we are focused on a Schedule 3 amendments in detail. Second day we will already discussed and gone through our CARO changes, which is one of the most important responsibility on the auditors. And today's day is something where there are small changes and amendments which are being done across accounting and auditing domain. So we are trying to complete everything, not only focus on the Schedule 3 and auditing standard, but however we are also focusing on the few very important, small but very important changes, and principally practically, as I discussed with Rajesh bhai, SMC definition and how it is going to change and impact our auditing and accounting finalizations during this period is going to be critical. One thing which I would like to highlight before I hand over the charge to Rajesh, that is from 1st April 2022, auditing trail, accounting software which you must use should have audit trail. That is the mandatory requirement for every company. So in my view, in case if any of you or clients are not using accounting software where mandatory audit trail is not been there, then kindly take the adequate steps to talk with your accounting software vendor, or if required, you may change the software. But however, we have to ensure that from 1st April 22, the software which you use is in compliance with MCA requirements. So with this brief word, I'm sure that this is beneficial to each one of you, and my compliments to each one of you to grossly engage into this knowledge learning session. And thank you so much, Rajesh. Back to you.
Thank you so much, Chintan sir. So our today's faculty, CA Rajesh Mody, for this amazing topic that we are going to have today, that is recent amendments in companies accounts rules and companies audit and auditors rules. So talking about Rajesh sir, he's a practicing chartered accountant in the field of assurance advisory, presently associated with CNK and Associates LLP as Director Statutory Audit. He was a partner at Mrs. Rajiv Shah and Company, which is a Mumbai-based 3-decade-old firm located at Fort. He was heading the assurance business advisory division in the firm. Rajesh Mody sir has over 25 years of experience in areas of assurance practices, internal audit and business advisory and a lot. His areas of expertise of course includes Ind AS, IFRS advisory and is one of the resource person on Ind AS related matter in the firm. Of course, his audit and assurance clients include public limited companies, private limited, multinational Indian firms, NBFCs, etc. He has hands-on experience in advising client of phase 1 companies in India's implementation and is advising phase 2 companies on India's implementation too. He's a regular speaker at various study circles, study groups for India's topic. He's also been a convener for Accounting and Auditing Committee of BCS for 21-22 and a core group member. He's a coordinator of IFRS study group of WRC ICI Mumbai, and he was instrumental in forming the IFRS study group in 2015, first of its kind in India. As you're aware, his expertise includes the entire India's implementation. He's been a part of various different committees, and his passion is definitely training and grooming the next generation on developing positive attitude, how to face adversities in any aspects of life, and majorly India's and implementation. Thank you, Rajesh sir, for accepting our invitation and guiding our today's participants. Over to you, Rajesh sir.
Yeah, thanks, Rajesh, for giving the kind introduction. And actually, our relationship goes back, I think, maybe 6-7 years back, when I think we had been together for 3 days. Some development program was going on at WRC, and we were a co-participant there, actually. And that's how I came in touch with you. And I know you are a fantastic faculty yourself, and you are grooming next generation students, and that's how I recognize you. And I appreciate your efforts which you have put into develop the next generation. And Chintan Bhai, thank you for giving this opportunity. I think we also go a long back in our relationship. And yes, you are also doing a very fantastic job for the institute, and now all the best for the new beginning and new council year, and hope you will carry on the good work which you have been doing since last so many years. And good evening, friends. Yeah, so as already summarized by Chintan Bhai, that today what will be the coverage of the topic. So I think again, congratulations to the committee that they have come up with this very timely and relevant course, actually, which will not only help the practitioners as well as the persons in industry to cope up with the extensive changes which has happened and which is going to impact for the first year when you are finalizing your accounts for 2022 March. And why it is more relevant is because not only you have to cover this year, but comparative figures are also required to be done. I think that's what over the last 2 days my co-faculties must have covered and emphasized that it is not only this current year but previous year also. And second thing, to implement or to compile all those information, according to me, it cannot be done manually or out of the books. It has to be from the system itself. So I think involvement of the IT people in your team, in the management team, will be important, because changes has to be done in the software itself for MIS, so that all these data can come from the system itself and cannot be done outside the books. Otherwise, I think, because this is going to remain, right, year on year, this requirement is going to remain. So it is better that things come from the system itself and nothing has to be done out of the books. So I think that is one of the main takeaway from this program. And it already, most of the big companies have already started long back, because all listed company has to give quarter results, 6 monthly balance sheets they are required to give. So maybe they were breezed with this situation, but for middle or small kind of companies, I think they also need to start already working on these things, and hopefully by the time they sign the balance sheet, they are ready with the things, and the auditor will be able to do the justice to their responsibilities, enormous actually responsibility with the MCA has bestowed upon them. And I think we will, based on our past experience, we will pass this with flying colors. That's what I don't have any single doubt that we will not be able to execute this responsibility. And yes, these type of programs which actually will help members to cope up with this responsibility, and they will get the proper guidance and timely guidance from the experts that how they should go ahead with fulfilling this responsibility. And I think as this forum is always actually like sharing the views, sharing the experiences, so your views are welcome. You can also, we can interact, and I think at the end of the day it is that collectively we all should be able to execute our responsibility, right? So that should be the takeaway, friends. So what I will do, my agenda is actually, first I will take up with company's accounts rules which is being amended, and basically it will cover two things. One is that already Chintan Bhai said that audit trail in the account software, which is actually is not going to affect my March 22 balance sheet, but it will affect next year, means starting April 22. So but yes, this is far reaching change with the government has made. And for small or medium size of entities, majority we have seen that they use tele software and such kind of software. So I think already those uh, softwares have undergone the changes, and I have been told that now they are ready with such kind of audit trail. But I am more concerned, friends, with the second part, that auditor also needs to report under rule 11, because there where I think they have said that not only the auditor is responsible to check, verify and report that whether the software has that ability, right, to maintain that trail. And however, the auditor has also verified that it has not been tampered with. Luckily this is going to happen next year, friends. But how as an auditor we are going to ensure that not only that the audit trails are properly maintained, but it has not been tampered with? I think that's where we will need to take some assistance from the IT people, or upgrade ourselves, so that we will be able to fulfill that responsibility. Because tampering is such thing where actually we will have to check, because that is the exact word in the that clause which I will be covering, at least that para which actually verbatim para which they ask us to report. So that is where I am more concerned, friends. So but institute is going to come up with the guidance maybe in the early few months. So there I think we will get the guidance that what should be our the extent of responsibility as an auditor. We need to comply with that thing. So that is one part I will be covering. Then as Jintan Bhai said, we will be covering the whole gamut, whether it is relating to company or as auditor. So they have made the amendments in company's account rules, which also covers amendment relating to board's report. I think that is also having a far-reaching effect, friends. So I will be touching upon what changes now board is supposed to actually cover, specifically the two clauses. So that we will be covering. Then I will be just touching upon the synopsis of Schedule 3 amendments. Already over the last 2 days, you must have extensively dealt into CARO, which is relating again with Schedule 3 plus Schedule 3 changes. But however, what I have done is that I have prepared a summary kind of thing, which will actually give you the buckets in which it can fall. So it becomes very easy to actually summarize and grasp the things properly in a proper perspective, so that it becomes easier to understand the changes. So that I will be touching upon, but I will not dwell into details, because already for last 2 days you have done that. Then I think I will be covering most important part, accounting standard rules, that amendment rules 2021, which actually applies to non-index kind of companies, where basically they have changed the definition of SMC, and it is again going to have far-reaching effect. So that's why I thought I will be covering in details that what is SMC, what is not SMC, what happens when there is a transition from SMC to non-SMC and vice versa, and whether as on 31st March 2021, if you are falling under the old definition and you are SMC under old definition, however now you fall under new definition and you are covered under as a SMC, then whether you can take that benefit or you need to wait for another maybe one more year to become an SMC. I think that transition related effect also we will be covering. And yes, we will go by the definitions, that what are the criteria to fulfill to be an SMC. So there I think we will extensively cover. And then I will go to another important amendment, that is relating to audit rules. There, as I said, under that 143.11, they ask us to report on A, B, C, D, that are the clauses. Now they have amended it and they have added E, F, G. So there now that our responsibility as an auditor has gone up tremendously, friends. And March 22 will be the year where we will be first time reporting on all those clauses. So, and this again will be having a very far-reaching impact. So as an auditor, we should understand first thing, that what are our responsibilities which we are going to fulfill, and we should be, and how much we are prepared to do it. So that is the whole purpose, friends. So I think now we can proceed with each of the items of my agenda which I am going to cover. So yeah, excuse me. So friends, this is MC updates on accounts rules. So Ministry of Corporate Affairs has issued notification dated 24th March 21 to further amend the company's accounts rules. These amendment rules may be called the Companies Accounts Amendment Rules 2021. They shall come into force on the first day of April 2021. So this was relating to that trail. Okay. So then what they did, so that was on 24th March. Then they further amended on 1st April and saying that they have deferred this by 1 year. So what was that rule? In Rule 3 of the accounts rules, in sub rule 1, the following proviso shall be inserted, namely, provided that for the financial year commencing on or after the 1st day of April 21, that has now been replaced with 22, every company which uses accounting software for maintaining its books of account shall use only such accounting software which has a feature of recording audit trail of each and every transaction, creating an audit log of each change made in the books of account, along with the date when such changes were made, and ensuring that the audit trail cannot be disabled. So friend, this amendment is going to have a far-reaching impact, and I think that's why they have deferred it, so that the software companies gets the time to enable this kind of requirement, because I think SAP or Oracle kind of software already has such type of things. But for small software companies or small software which normally the majority of the small firms use, there's such kind of trails were not mandatory, and that's why they were not properly incorporated. So those company have short time, and that's why government has deferred it by 1 year. And hopefully by now all the software should be in line with this. And what I feel that maybe in the future, that is one of the thing I think that it may happen, that maybe MCA may come up with the list that okay, these are the softwares which are in compliant with the requirement, and maybe these are the software which are maybe blacklisted or maybe not desirable because it is not in compliance. I think maybe one of the things which may come up in future. So we have to wait how the things roll out, friends. But yes, because this is the accounts related change, and simultaneously, as I said, under 143 in 11 also they have made the changes for other reporting requirements, and there they also inserted that as auditor we have also to see that these trail are there, and it has not been tampered with. Okay, and it has been maintained for the period for which was required to be maintained. So like for the books of account, we generally know that as a thumb rule 8 years they have to maintain. So audit logs has to be maintained for that period, and it has not been tampered with. I think this is the auditing reporting requirements which the government has asked us, and so we will be reporting from the next year, friends. But yes, we should be aware, and wherever you are as an auditee or as an auditor, you have to bring this awareness to the client that please ensure that you take up this matter with your IT team or maybe the software guy who is actually doing it, and ensure that all these requirements are fulfilled, because going forward from April this is mandatory. So I think that is the time, and this is what I think as an auditor we need to make awareness to our clients. Now another change they have done is in rule 8 of that company accounts rules. So if you see, friends, rule 8 and there is rule 8A. So if rule 8A actually applies to one person company and small company, rule 8 applies to other than small company. Okay, so if audit is a small company as per the definition under the Companies Act, then maybe this this applicability will not come. Okay, but however, if you are not a small company, then in the board report, because this rule 8 applies to the board report, and so nothing to do with the accounts, but matters to be included in the board's report. Okay, so there actually they have inserted two new clauses, that is clause 11 and clause 2 in sub rule 5. Okay, so what is that? The details of application made or any proceeding pending under the insolvency and bankruptcy code during the year, along with their status as at the end of the financial year. So friends, this is a very relevant amendment, because now the board report will have to be specifically speaking order that yes, whether during the period any application is made or any proceeding is pending under IBC code, along with their status at the end of the financial year. So actually the reader will be getting it in a summarized form that if such thing has happened, if yes, then what is the status at the end of the year. And second part, that is also again very important, friend, the details of difference between amount of the valuation done at the time of one-time settlement and the valuation done while taking loan from the banks or financial institutions, along with the reasons thereof. So what I foresee, that what was the need for the government actually to bring in this two clauses. First clause is yes apparent, because they want to provide that information which is coming out from the board itself, that yes, this is what the status is as far as the IBC is concerned. However, the second part, if you feel see, friends, generally what has happened, wherever such kind of any company is referred to IBC, always there is a loss to the investors, loss to the government, loss to banks. Everywhere we have seen there is a erosion in value, right? and so always that fingers are pointed either to the management or to the auditor. Okay, there are two more agencies like auditor. They are also very capable, very professionals, right? But I think somewhere it was the feeling that only why this one professional is to be held accountable when there are other professionals also who are equally responsible and accountable as far as the services which they provide to the entity. If you look at that, I can foresee two professionals. One is independent directors, and these are my personal views. Okay, friends. So I am sharing that one can be independent directors, where I have time and again we have found that there is no direct responsibility or accountability fixed on the independent directors on what the roles they had played when such kind of erosion was happening, or when the company was making the defaults, and they ultimately they had to be referred to the IBC. I think that was one part. Second part was the limelight was not, or focus was not on the valuer. So if you see the 2013 amendments, now they have a separate empanelment, they have separate rules for valuers, who can do valuation, who cannot do valuation. I think so now they have given that importance to the valuer also, and now they also want to fix responsibility and accountability on the valuer also. I think this is what the major difference, friends. Yes, management is the first responsible auditor, because yes, he was required to audit the things and give his opinion. That's why he should also be held responsible as far as whether he has done proper justice to his work or not. Same way, independent directors and valuer also, according to me, where the gray areas where it was not properly affixed that what should be their accountability. By bringing this specific disclosure in the board's report, I think one of the missing link, the government is trying to bridge that gap, and now specifically now the board will have to report that what was the value as per the valuation done at the time of actually taking the loan, and what is the valuation as per the valuer at the time of one-time settlement. Because see, many times what happens that it will not take years. Maybe loan was taken 3 years back and company has gone bust within 3 years, and they may have to be referred to the IBC. That is also possible. So how can within that 1 or 2 or 3 years period there can be so much erosion as far as the valuation is concerned, right? So I think this is a welcome change, friends, and I think it will help early warning signal, or maybe bring that accountability as far as the other professionals are also concerned. So this is the step in the right direction, and yes, overall it will help proper more corporate governance kind of thing. That is what my personal view is, friends. Let us wait how it rolls out in future. Now, so this was actually, friends, as far as the company accounts rules 2014 is concerned. So there we have only majorly for 2022 March only board report changes are applicable. Audit trail will apply from next year, and as I said, for small company board report need not cover this thing. Other than small company, this will be mandatory under rule 8. Now, before I go to the accounting standard rules, I thought let me summarize the amendments which are relating to schedule 3 and how we can bucket it in separate buckets so that it becomes easy to summarize and grasp it. So as we all know, again on 24th March, the institute, the MCA had come out with the amendments to schedule 3, and key amendments can be divided into 3 divisions. As we all are aware, division 1, which applies to the companies which are not Ind-AS companies, where accounting standard rules 2006 earlier, now it is accounting standards rules 2021, actually, because they have now comprehensively replace the accounting standard rules 2006 with companies accounting standard rules 2021. So that is what we are going to cover. Say division 2, which will apply to the companies which are covered under companies Indian accounting standard rules 2015. And then division 3, I think that's what you are going to cover tomorrow. Division 3, which applies for NBFCs whose financial statements are required to comply with companies Indian accounting standard rules 2015. So I think this is the 3 divisions broadly where the amendments in schedule 3 will apply, and that is applicable for March 22 financials. So it will apply for financial year beginning on or after 1st April 2021, and as we are aware, dry run for 2021 will be required because comparatives are mandatory. So super important as comparatives have to be given next year, and many amendments will be tough for many companies. So yes. So buckets. So what the amendments trying to achieve? One part we can see, look at it at from the enhanced disclosure for more oversight on governance. So that's why they have brought in any changes in the promoters shareholding. You have to give who are the promoters, or their shareholding has to be given. So that is now covered under schedule 3 itself. MSME disclosure now compulsorily on face of the balance sheet, because we have come across many companies where MSME disclosure was not given on the face, but as a part of the notes it was given, but now it will be on the face. Registration and satisfaction of charge related details has to be given. More than 2 layers of subsidiaries, I think as you know, it is not permitted, but if at all it is there, then details has to be given. Compliance with the scheme of arrangement. So if you have undergone any scheme of arrangement like reduction of capital or merger amalgamation, so whether the accounting standards and the compliance requirements have properly been carried out or not has to be now specifically disclosed. So that is welcome change. Working capital reconciliation, statements filed with banks reconciled with books of accounts. I think very relevant. So again, far-reaching impact and has to be disclosed. And also in Caro also, I think they have covered this. So auditor also has to be reporting on this, as well as the company has to disclose. So friends, actually before I go further, if you have seen Caro 2020, which we see was actually originally applicable from 1st April 2019, and it was deferred by 2 years. First for 1 year, and again they deferred for another year, and so now it is applicable from April 21. So actually, if suppose there was no amendment in schedule 3 and only Caro reporting was applicable, suppose suppose the original date was 2019 and they had gone ahead with that applicability, then what would have happened? Actually, if you see, the primary responsibility of maintaining the books of accounts and financial statements is of the management, right? And then based on those books of accounts and the financial statement, which includes presentation, disclosure, everything, the auditor will have to report that whether it is proper or not and whether it is true and fair. Okay, so had they have not made amendments in schedule 3 and carried on with the Caro amendments, then what would have happened? That on one side, the management, who is the primary responsible for preparation and making the financial statements true and fair, disclosure proper, they were not disclosing such things, and auditor had to report on those disclosures which are not there. So actually what would happen, that all responsibility would have been on the auditor and simultaneously not holding responsible to the management, because they are not actually disclosing the things. So actually now what has happened is that that balance has been restored. Okay, so that from the same date, means 1st April 2021, the management first actually prepares the books of account, make the presentation as per the revised schedule 3, make all the disclosures which are required as per revised schedule 3, correspondingly that CARO also will cover all those disclosures, and then the auditor is reporting on those disclosures. I think now both are held responsible as far as their own areas are concerned. So I think that way that balance has been brought in, and I think maybe whether it is a coincidence or I don't know, but whatever has happened, it is for good that now both the companies and the auditors are equally responsible for their part of whether disclosure or reporting. So that balance has now been properly restored. I think that's what the conclusion is. So it is good, friends. So going forward, revaluation impact beyond 10% now specifically has to be given. Revaluation by register value or wherever it is there, details has to be given, so that we can put it in disclose or enhanced disclosure for more oversight on governance. Second can be financial discipline or solvency. So friends, under schedule 3 as well as CARO will say that based on whatever, whether the company will be able to repay, right? So whether it will be able to survive or going concern, whether it is there or not. So that is the auditor. But as far as the schedule 3 is there are a host of ratios which now specifically the management has to disclose, right? So you will need 3 years because the comparison is required. So you will have to have the financials for 20, then 21, and then 22, so that comparative ratios and variance, if it is more than 25%, then the management has to also give the reasons for the variance, maybe plus or both, positive, negative, both kind of variance are covered. So you, at least for 3 years you will need this. And second most important thing, you have to see that wherever the ratios are given anywhere across the that document, including board report, MDA analysis, anywhere, it should be in line with and it should be consistently applied. Because as an auditor, we also have to report under SS 720, where we have to see that other information also are in line with the disclosures made in the financial statement. So that one has to keep in mind. Second thing, under tax audit also we are giving certain ratios, so that also one has to keep a stand that your ratios cannot be different for different purposes, because that also otherwise it can be a problem. Aging of trade receivables, aging of trade payables, CWIP aging, CWIP time and cost overrun. I think far-reaching effect as far as these 4 items are there. Transactions not recorded in books, undisclosed income, CSR spend. I think for any other agency like income tax, now they will have everything on platter, and so the companies and the auditor will have to be consistent with whatever disclosures they are making. And actually, as I said, nothing can be manually prepared. It has to be from the system driven, because these figures are freezed as far as the, because these are public available in the public domain. So you can't it's just not an MIS now, it is part of your financial disclosures. So one has to be very careful that it is going out in the public domain and it will be lying with the authorities. So whenever that scrutiny comes, they have the figures with them. So whatever tabulations you present at the time of scrutiny has to match with this. So far-reaching impact, friends. So I think once the things starts rolling, then only that impact one will be able to fathom, but far-reaching according to me. Money laundering, early signals, yes. Dealing with struck-off companies, Benami transactions, immovable property not held in the name of the company, willful defaulter declaration, loans given or loan received for transfer to other entities. I think this is another case where it has been directly picked up from maybe ILFS kind of scenario, where funds were evergreening was happening, or maybe funds were given with the specific purpose for some beneficiaries. So I think the government has tried to bridge in those lapses or loopholes. so that everything is made accountable and transparent and brought in the books. End use of borrowed funds, loans and advances to promoters, directors, relatives, dealings in cryptocurrency or crypto assets. I think majorly out of the experiences what the government has done in last maybe five years, they have tried to bring in. And then there are few minor changes, friends, that rounding off now total income versus turnover. So now you have to, instead of putting total revenue in the P&L, you will have to put total income. Okay, and now rounding off it is now mandatory. It is not may, now they have replaced may with shall. So whatever in whatever bracket you fit in, accordingly you will have to present your figures in maybe hundreds or thousands of lakhs. So that is mandatory, friends. Security deposit, it's just a classification change, but that was required. Tangible assets, to bring it in line with your accounting standards, so they have made nomenclature, they have changed. Lease liability, again for Ind AS entities it was important that whether it should be shown as other financial liability, other financial liability, other current liabilities, or as a separate line item as the lease liabilities. I think there were inconsistent practices, so bring uniformity they have brought in. So see revised for Ind AS entities, and NBFCs for few ratios they have actually added. Yeah, so friends, this was actually what I felt, that that schedule 3 amendments can be summarized into these brackets, and it becomes easier for one to fathom if we keep in mind what was the intent behind the changes. So it becomes easier for us to actually grasp the things and summarize things. Now going to my next topic, friends, is Companies Accounting Standards Amendment Rules 2021, which is effective for financial year 21-22 onwards. So this is for non-Ind AS kind of companies. So on 23rd June 21, the Ministry of Corporations notified Companies Accounting Standard Rules 2021 in consultation with NFRA. These rules are applicable for non-Ind AS companies. It means those companies who do not have to apply Indian accounting standards as notified under Companies Indian Accounting Standard Rules 2015. The rules contains the definition of small and medium sized company, SMC, which is different from the previous equivalent definition. So again, in the background, friends, the government made the changes in MSME Act, and there they have increased the threshold limit who are covered under each category MSME. So, and based on that, our institute had also made the changes in the accounting standard which are applicable to other than means non-corporate entities. There also, I think for level 1, level 2, level 3, level 4, they had made the similar changes by increasing the threshold. So the MCA also to bring everything uniform, they also made the amendments in the company's accounting standard rules by making the same threshold applicable to SMC, which was there for under MSME. They made the changes so that it becomes uniform across the board. So under the MSME, whatever is the definition of SMC, same thing they brought in the accounting standard rules, and same the institute did for non-corporate entities. But there is a different, we have 4 layers here. Only we have SMC and non-SMC. Okay, so this is the thing. This may change the SMC or non-SMC status of a company and resultantly cause changes due to optional exemption or relaxations from the measurement and disclosure requirements under certain accounting standards. So actually what has changed? If you tell me the relaxations or exemptions has not changed. Okay, previously also whatever was applicable to SMC, still it applies. Only thing that the criteria to define what is SMC or non, that itself has gone has changed tremendously, right? So that's why my focus here will not be what are the relaxations or exemptions, because that we already know. Okay, Point is where I fit in, whether I am SMC or non-SMC, that, and when to look at it, what are the criteria to fulfill, and what will happen. As I in the initial stage I had mentioned that as on 31st March 21, under the old definition of SMC, you are non-SMC, then whether you will be eligible to get the benefit of SMC because of the increase in thresholds as per the new definition. I think these were the transitional kind of queries which generally crops up, and that's why I thought that I will focus more on such things. So friends, with that, I think let us cover. The accounting standards shall come into effect in respect of accounting periods commencing on or after 1st April 21. Applicability: every company other than companies on which Ind AS notified under the company's Indian accounting standard rules are applicable, and its auditor shall comply with the accounting standards in the manner specified in the annexes. So for Ind AS companies, we have a separate set of accounting standards. So this applies to non-Ind AS kind of companies. The accounting standards shall be applied in the preparation of the financial statements. So now we have 3-tier accounting standard framework, friends. Therefore, with these rules coming into effect, we would have a 3-tier accounting standard frameworks for companies under the Companies Act 2013. It must be noted that the accounting standard issued by the ICAI shall be applicable for non-corporate entities such as LLPs, partnership firms, proprietary concerns, or other enterprises carrying out business, industrial, or commercial activities. So that I was talking about our non-corporate entities wala jo layer 1, 2, 3, 4. That's what institute has come up with the standards. These are the standards which have been notified by the MCA, which applies to the companies. So what is that 3-tier accounting standard framework? One framework is Ind AS, which applies to listed entities. We know this: companies with net worth of 250 crores or more, or any holding, subsidiary, joint venture, or associate companies of the above companies. Then we all know that they have to follow mandatorily Ind AS standard. And what are Ind AS standard, friends? Those are IFRS convert standards. It means IFRS based standards with certain carve outs. Okay. Second layer can be second tier can be accounting standards. All companies not covered in Ind AS criteria, it means non-listed companies with net worth less than 250 crores and not having any holding, subsidiary, joint venture, or associate companies covered in Ind AS criteria, then you are covered under that second tier, that is accounting standard. And what are accounting standards? That are non-converged accounting standards. Plus, banks and insurance companies currently apply accounting standards till the time they are made to apply Ind AS. Okay, now NBFCs are covered for under Ind AS, but as far as the banks and insurance companies are concerned, that applicability of Ind AS has been deferred, and that's why till the time they go in for Ind AS, they will have to comply with accounting standards. And then we have third set of companies with some relaxation, that is they will apply accounting standards but with relaxations because they fulfill the definition of SMC. Okay, so non-Ind AS companies meeting all following criteria. What are those criteria to be fulfilled to become part of that SMC? Turnover not exceeding 250 crores, borrowing not exceeding 50 crores, and it's not a holding or a subsidiary company of any non-SMC. So if you are a holding or a subsidiary of any non-SMC company, then I think you will not be able to take the benefit of SMC, even though you may actually fulfill the other two criteria of turnover and borrowing, because you are a holding or a subsidiary of a non-SMC company. Non-converged accounting standard with certain measurement exemptions and reduced disclosure, I think that I have a separate slide, I will be covering that, but my focus will be those criteria for getting the relaxations to fulfill SMC. So now coming to the criteria or definition of SMC as per the accounting standard rules. First is whose equity or debt securities are not listed or are not in the process of listing on any stock exchange, whether in India or outside India. So that is the first criteria, friends. So if you are already listed entity, whether it is debt or equity, or if you have already decided and you may have actually gone ahead with the process of listing, then actually you cannot be an SMC. So you will be outside the purview of SMC definition. Then you will be non-SMC, which is not a bank, financial institution, or insurance company. We have seen that banks, financial institution, insurance company has to follow that second tier. They fall into second tier, so you will not get the benefit of SMC. Third is whose turnover, excluding other income, does not exceed 250 crores in the immediately preceding accounting year. Okay, so friends, all these criteria are cumulative criteria, so you have to fulfill all the things. If any one of the criteria are not able to fulfill, then automatically you will become non-SMC. So to be SMC, all the criteria, okay, I'm emphasizing all the criteria you have to fulfill cumulatively. It is and not or. Okay, and which does not have borrowing, including public deposits in excess of 50 crores. Now here ऊपर में क्या था, turnover in the immediately preceding accounting year. So turnover, normally I will look at the end of the period, that year. For borrowing, they are using the word at any time during the immediately preceding accounting year. So what does it mean? So even if suppose at the end of the year I have deposit of only 30 crores, okay, but during there at any single day, if my borrowing had crossed that limit of 50 crores, so even if I don't have even 30 crores at the end of the year, because the wordings used are at any time during the immediately preceding accounting year, I will not fulfill this criteria, so I will become non-SMC. So this is how each word used are important and relevant, friends. So you have to see what they intend. And which is not a holding or subsidiary company of a company which is not a small and medium sized company. So if you are not means your holding or subsidiary also has to be SMC. If they are non-SMC, then automatically holding or subsidiary of that company also becomes non-SMC by default. So if you fulfill all these criteria, and for this last one, which is not a holding or subsidiary company, the status you have to look at the end of the year, friends, because that is why the explanation has been given. For the purposes of this clause, the company shall qualify as a small and medium sized company if the conditions mentioned therein are satisfied as at the end of the relevant accounting period. Okay, so as on the last date, you have to see whether you are a holding or a subsidiary of such company or not. Okay, so as already said, the definition of SMC is cumulative. It means in order to be considered SMC, a company shall not fall in any of the four criteria in the definition. Example, a company has a turnover of rupees 240 crores. The company's borrowing is 55 crores. So here in this case, even though you fulfill the first criteria that turnover is below 250 crores, but second criteria that borrowing should be not exceeding 50 crores. Here you are not fulfilling that criteria, so it shall be considered as a non-SMC since it is not meeting the borrowing criteria. So cumulative. Now listed criterion. The definition exclude companies whose equity or debt instruments are listed on any stock exchange in India or abroad. Okay, so if you are listed, then automatically you cannot be SMC. Now forget about equity. Suppose only your debt instruments are listed, then whether, because simultaneously MCA notification dated 22nd January 21, they have amended the definition of listed company under section 2 subsection 52, friends. Post these amendments, companies whose debt instruments are listed shall be excluded from the general definition of listed company under the section 252 of the Companies Act. So whether the change in the general definition of listed entity, can a company take a clue and say that whether, because my only debt instrument are listed and not my equity, so can I say that as per the amendment in section 252, now I can take the benefit of not being considered as a listed entity, and so that if I fulfill all other criteria of turnover or other borrowings, then can I become an SMC? I think this is what the I thought I would post this for the members to deliberate. So Chintan bhai, what can we do actually? Can we ask them to give the reply in the chat, or what how we plan? Okay friends, I think he is not there. Okay, so according to my view, because see, this is the problem with virtual kind of mode. If we have physically present, then actually we can always have an interactive session directly. You can interact with me, but yes, we'll have to go by the whatever best we can get out of the technology. We have to make use of it. Yeah, so if you look at the things now friends, this is general definition, right? But however, if you see the definition which I have used specifically in the amendments of the accounting standard rules 2021, they have specifically covered that who will be covered, who will not be covered. Had they wanted it to give exemption, then they would have easily said that they would have referred it to the general definition of the section. Instead, they have specifically mentioned here. So wherever there is a specific requirement, that should prevail according to me. And so if you, I can give you another example under Indian Accounting Standard Rules 2015. They have given exemption to SME kind of if your company is listed on SME stock exchange, right? Then they have said that Ind AS will not apply. So they have specifically excluded. If they wanted to exclude somebody, then they will give specific exclusion. So here actually they have not referred to the listed entity definition under that section, general section. So we have to go by the specific criteria which they have used for that relaxation. So here they have specifically covered debt security. So we cannot take the benefit of general provision. We have to go by the specific provision. So this is my view. So even though debt listed securities may not be treated as a listed entity as per the general definition under Companies Act, but as far as the fulfillment of criteria under SMC definition is concerned for the applicability of accounting standard rules, I think debt listed securities also will be covered, and accordingly that SMC exemption or relaxations you cannot get it. Now going forward with that same thing, a definition covers any stock exchange in India or outside India. Therefore, even if a company's instruments are listed outside India, they will be covered. Now another thing is date of assessment to be assessed on which date. So they have said now the process of listing, right? Listing criteria. It is not clear whether the listed status shall be assessed at the date of the notification of the rules or at the end of the immediately preceding financial year, as they have mentioned for the criteria of borrowing or turnover, or at the end of the first financial year, at which point these rules are applicable. It means 31st March 22, or at any point of time after these rules were notified. So friends, on which that listed entity criteria has to be verified. That is the question here. So these are the four possibilities, friend, where one can say that yes, this is the date where I would assess that whether my entity is a listed entity or not. Because many times what happens that yes, during in the beginning of the year the entity may have been the listed entity, but during the year it may have gone for delisting, and as on the 31st March maybe 22, it means what we say that the reporting date, that entity is not a listed entity. So it can say that yes, now because I am not a listed entity, I can go for SMC exemption if I fulfill other criteria. So I think that's why from that point this status of date of assessment becomes relevant, and that's why I thought let me put this poser. So according to me, friends, the criteria has to be seen as on the last date, it means 31st March 22, because that is when I will check whether I am fulfilling that criteria or not, right? And we have guidance available in ITFG bulletin issue number 3, bulletin number 3, issue number 8, which deals with the similar kind of issue for applicability of Ind AS under Ind AS roadmap. The listed status to be checked on the date of applicability and not before that. So 31st March 22 is the date when you have to see. If you are not listed on that particular date, then you can take the benefit of SMC. If you are fulfilling other criteria, I think that is the date of assessment. The second part of definition says that the definition also exclude companies in the process of being listed from the definition of SMC. Now a question may arise as to at what stage can it be said that a company is in the process of listing, as a company may have listing aspirations within the next 3 to 5 year or time horizon. So which one when I can say that yes, I am the process of listing, because the intention can be always there, right? Because if you go for any startup kind of thing where venture capitalist or equity private equity investors are there, they always will have that agreement in place which will say that yes, within next maybe 3 to 5 years they will need a exit and by way of IPO, right? This is how it is there. So can we say that the date when the agreement is signed, that can be said the company is in the process of listing? So whether intention becomes the process, or there has to be something concrete to prove that there is a process of listing which has already begun, and so that is the date when I can say that yes, I am fulfilling the criteria, so I cannot be SMC. Friends, again, according to me, that either one is that suppose you board has passed the resolution that company is going ahead with the IPO, means starting the process of getting listed, and that's why this is the roadmap, this is the time frame. They already appointed a merchant banker, they have fixed the date for filing that draft red herring prospectus. I think some concrete evidence has to be tabled for the auditor actually to confirm that yes, the listing process has begun. See, the wording is not the intention, the wording is company in the process of listing. So process means there is a process which has already begun, right, friends? So it starts with the board resolution and the appointment of merchant banker, appointment of other legal advisors, right, valuers, all those people, and draft hearing red hearing prospectus is ready or maybe have been filed with the SEBI. I think if this conditions are fulfilled, then we can say that is the date where the company can say that yes, the company is in the process of listing, and then from that date you can say that now it cannot be SMC. So some concrete evidence has to be and for the SEPR side, final concrete proof is that if DRHP is filed with the SEBI, then no further proof is required. That can be the date when one can say that company is in the process of listing. Banks, financial institutions, insurance companies, we have covered. It is all specifically because they are public interest entities, so they cannot be part of SMC. They are actually not SMC, and that's why they have to go by the whole standards. Such companies shall have to continue to apply accounting standards in full. Of course, in tandem with the relevant RBI or IRDAI regulations, because that prevails always. Now, having seen two major criteria, now let us go to turnover criteria. Unlike the applicability added in the Ind AS roadmap, the definition of SMC in the rules have a turnover criteria. So here it is not linked with your net worth, it is linked with your turnover. Okay, to be in line with the MSME criteria. So what is that turnover? Specifically, it excludes actually other income. Okay, and turnover criteria shall be assessed based on the immediately preceding accounting year of the company. For example, if a company is evaluating whether it is SMC or otherwise under these rules for financial year 21-22, it shall consider the turnover excluding other income as reported for financial year 2021. Now, what is here only point is that we should be very clear what is other income and what is not other income. So point is that what will fall under my other income and what can be fall under my other operating revenue. I think that is where there can be some, but I don't think it may have major impact. But yes, and I think this is the old thing, not new thing, where we have lots of clarity under our guidance, not under Schedule 3. It very specifically states that other operating revenue would include revenue arising from a company's operating activities, right? Either it is a principal or ancillary revenue generating activities, but which is not revenue arising from sale of products or rendering of services, because that will be my main turnover. Whether a particular income constitutes other operating revenue or other income is to be decided based on the facts of each case and detailed understanding of the company's activities. Suppose, for example, a group engaged in manufacture and sale of industrial and consumer products also has one real estate arm. If the real estate arm is continuously engaged in leasing of real estate project properties, the rent arising from leasing of real estate is likely to be other operating revenue and not other income, because it's a continuous activity which the company is carrying out, right? On the other hand, consider a consumer products company which owns a 10-story building. The company currently does not need one floor for its own use and has given the same temporarily on rent. So here the wording is temporarily on rent and not a continuous activity. In that case, lease rent is not an other operating revenue, rather it should be treated as other income. Same way, sale of property, plant and equipment, which is not an operating activity of company, hence profit on sale of PPE should be classified as other income and not other operating revenue. This is very clear, friends, right? On the other hand, sale of manufacturing scrap arising from operations for a manufacturing company should be treated as other operating revenue, since the same arises on account of the company's main operating activity. I think these are all done and dusted and settled things, friends. So I don't think there can be any ambiguity as far as what can be my other operating revenue and what can be my other income. So having seen the turnover criteria, now let us go to the next criteria, that is borrowing criterion. The definition of SMC excludes companies which do not have borrowings, including public deposits, in excess of rupees 50 crores at any time during the immediately preceding accounting year. Now, friends, borrowing is not defined in the rules. It shall generally include all loans, debentures, bonds, and other debt instruments issued by the company and public deposits. under Companies Acceptance of Deposit Rules 2014, an advance or deposit or credit balance in the books of a company may be considered as a deemed deposit. So now the limited point which we need to consider is, for the purpose of inclusion in the borrowing, whether such deemed deposit which the company's accounting acceptance of deposit rules has brought in, right, for which the companies are required to file DPT3 also, whether those kind of advances in the nature that can be covered as a part of borrowing or not. I think this is the limited query which I would like the participants to actually explore. And according to me, yes, this deemed deposit has to be included as a part of public deposit for the purpose of calculation of that limit of borrowing, because that specifically if they have made changes in the deposit rules and the intent is to include such kind of deposit as a part of deposit, then I think as per my view, we have to even include deemed deposit for the purpose of calculating this borrowing limit. That is my view, friends. You can have a different view, but because that definition of deposit is inclusive, friends. Okay, and one argument can be they have used the word public deposit, right? And under the section 73 to 76, they have defined deposits like public deposit, deposit from members for eligible companies, right? Then we have exempt deposits under the acceptance of deposit rules, and then we have deemed deposits. So there are various kinds of deposits. So here if they are saying including public deposit, then should we restrict only to public deposit, or we have to go and search for such kind of deemed deposit also, right? But according to me, friends, the definition is inclusive definition, and if you have accepted deposit, exempt deposit is of course not covered, but if the deposit is deemed under the rules itself, then it becomes public deposit according to my opinion, because it is not from the members, and so has to be actually covered according to me. And this I think I already covered. The threshold is not based on the year-end borrowing balance, but based on the borrowing at any point in time during immediately preceding financial year. Therefore, if a company had borrowed funds in excess of rupees 50 crores but has repaid part of the borrowing prior to the year end, it would be considered as non-SMC despite the year-end balance being below the threshold of rupees 50 crores. I think this is what we already touched upon. Holding subsidiary relationship criteria. I think this is the last part of that SMC criteria definition. If a company is holding, if a company is a holding company or subsidiary company of another company, which is a non-SMC, right? Therefore, if a company has a non-SMC company in its group, means subsidiary or holding, it also will become a non-SMC. However, the criteria does not cover joint venture or associates. Unlike the India specifically says that joint venture associates are also covered, right? So in this case, they have not covered joint venture and associate. They are saying only holding or subsidiary. So if in your group you have joint venture or associate, then you are actually still you can be SMC. You are fulfilling other criteria. Okay, so that is partial benefit you are getting compared to India's roadmap. The definition provides an explanation that states for the purposes of this criteria, it means only the holding or subsidiary relation criteria company shall qualify as a SMC if the conditions mentioned therein are satisfied as at the end of the relevant accounting period. Okay, this means that, for example, a company A Limited had a non-SMC subsidiary on 1st April 21. Okay, on 1st March 22, A Limited disposes of the non-SMC subsidiary, and A Limited meets all other criteria in the SMC definition, like it is not listed, it is not in the process of listing, it does not have turnover more than 250 crore, it does not have borrowing more than 50 crore. Then because it does not have holding of subsidiary as on 31st March, which is a non-SMC, it can get the relaxation benefits of SMC. Since A Limited does not have a non-SMC subsidiary as at 31st March 22, it shall be considered as a SMC on 31st March and would therefore be eligible for the exemptions or relaxations provided in the standards for SMC. So here you have to see the position as on 31st March 22, okay, as on the reporting date. So maybe during the year it may have a hold or maybe a subsidiary of an SMC company, but if it has disposed of before the year end, then the position has to be seen as on the last date of the year, and that is 31st March. And if you are fulfilling other criteria, then you can get the benefit. Now friends, having covered actually SMC criteria as per the definition, now important will be change in the SMC criteria. So what happens if you are non-SMC and then you become SMC, then whether you can get the benefit immediately, you will have to there is a waiting period. What happens if you are SMC at present and now you become non-SMC because maybe you become holding or subsidiary of non-SMC or for other reasons, then immediately you have to comply with the difficult task, or you are given some leeway. I think this is what is important, friends. So let us take first part, that is on the left hand side, non-SMC to SMC. Clause 5 of the rules states that when a non-SMC becomes a SMC, it shall not avail any SMC exemptions or relaxations in the accounting standards until the company remains SMC for 2 consecutive accounting periods. So friends, here the problem is in this transition, they have not said that whether you are non-SMC under the old rules or under the new rules. They only use the words that if you are non-SMC at present, and then as per the new rules you are becoming SMC, still you will have to follow all the standards because you will be considered as non-SMC only, right? And you will have to remain SMC for 2 consecutive accounting periods to avail the exemptions available to SMC. Okay, so 31st March 21, suppose you are non-SMC as per the old rules, okay, old definition, and now because of that enhanced limits, right, you become SMC. Still you will have to continue to follow all the accounting standards applicable to non-SMC for March 22 as well as March 23, because they need that 2 consecutive years you should be SMC. Then only in March 23 you will be able to avail the benefit of SMC. Till that time you will have to follow all the accounting standards which are applicable to non-SMC. I think this is very important. Now coming to the other criteria, when you are SMC and now you become a non-SMC, so whether you should be forced to make changes immediately or you are given some leeway. So there clause 1.2 of the annexure A, general instructions to the rules, says that when a company that was previously meeting SMC definition no longer meets the SMC definition, all the relevant accounting standards and requirements shall become applicable from the current period. So here important is that you are given some leeway. Okay, so only because now you for the current period you become non-SMC, So apply all the accounting standards for the current period. However, you may not make any changes as far as the previous year is concerned, because in the previous year you will still be considered as a SMC. Okay, so what will happen that in the previous year you are not supposed to make any changes, so that you apply all the stringent accounting standard disclosures and presentation requirements, because you are SMC last year. However, because now you are become a non-SMC in the current year, so current year figures will be based on the applicability of all the accounting standards. Previous year will be including some relaxations which you may have enjoyed. So this is what the leeway the standard gives. The company shall disclose the fact, but however you have to disclose the fact. The company shall disclose the fact that it was an SMC in the previous period and it had availed SMC exemption or relaxation shall be disclosed in the notes to the financial. So actually, not only you have to say that yes, I was SMC in the previous year, but you will also have to specify what are the exemptions or relaxations specifically you have availed in the notes to the financial statement. Then only the reader will be able to judge that okay, in the previous year which are the figures where maybe you have gone for some exemptions, so those figures may not be comparable. I think that reader should know. So I think that's what we have covered this, that you will have to continue to fulfill SMC criteria for 2 years consecutively, then only you can take the benefit of SMC. Otherwise you will have to continue to be non-SMC. This is from SMC to non-SMC. A Limited as an SMC on 31st March 21 fails to meet the SMC criteria as on March 22. So for 21-22, A Limited cannot apply any of the exemptions. A has to apply full accounting standards for March 22. However, in the financial statements for 21-22, the figures for the corresponding period of FY 2021 need not be revised or restated merely due to by reason of it having ceased to be SMC. A Limited shall disclose the fact that it was an SMC in the previous period and it has availed SMC exemptions or relaxations in the notes to the financial statement. I think simple. Most important, friends, unreserved and explicit statement of compliance. This has to be given, so don't forget to include in the financials. Clause 1.1 of the annexer A, general instructions to the rules, states that a SMC which avails any exemption or relaxation in any accounting standards, including disclosure or exemption or relaxation, it shall provide a note in the financial statements the fact that it is an SMC and has complied with the accounting standards insofar as they are applicable to an SMC. The clause provides the format for the note as follows. The company is a small and medium sized company as defined in the Companies Accounting Standard Rules 2021, notified under the Companies Act 23. Accordingly, the company has complied with the accounting standards applicable to a small and medium sized company. Friends, this is very important, because if you don't put this, then you will be treated as a non-SMC. So don't forget to put this, otherwise it will be treated as a non-compliance. However, if you are SMC, then is it mandatory for you to go for that availment of exemptions or relaxation, or it is non-mandatory? Friends, standard gives you the option. They say it is not mandatory that you must go by that exemptions. You can say that even though I am SMC, but I don't want to opt for that exemptions, I want to comply fully with the accounting standard. You are free to do, but you will have to accordingly disclose. Okay. And wherever SMC, you are saying that yes, I am SMC and I want to go for relaxation, then you can say that out of the, suppose AS 15, there can be maybe 5 or 10 relaxations, you say that yes, out of that 10 I want to only avail 2, rest I would like to comply with, then you will have to specifically mention that out of this AS 15 I have specifically gone for this exemption, maybe 2, so specifically mention these 2 exemptions I have availed, so that the person reading the financials will know that how to make it comparable. Okay, so this we have said that it is optional and not mandatory in nature. However, the rules require clear disclosures of the exemption or relaxation availed. And most important, friends, can you cherry pick the exemptions or relaxation in order to actually mislead the reader? I think that is specifically not permitted, friends, because that is what the clause 1.5 is saying, that if you go for a partial exemption, relaxation and disclosure shall not be permitted to mislead any person or public. So deliberately you are cherry picking something to mislead the reader, that will not be permitted. So I think overall, if you look at the things, we will go to the actual list of exemptions or relaxations. According to me, if you are well equipped, then I think you should not go for any exemptions. You can go for the full compliance with the accounting standard. That is what my personal view is, but it is up to the management to take a call. And however, this is always there, legal override. Accounting standards which are prescribed are intended to be in the conformity with the provisions of applicable laws. However, the rules state that if due to subsequent amendments in the law, a particular accounting standard is found to be not in conformity with such law, the provisions of the said law will prevail and the financial statement shall be prepared in conformity with such law. So always the law will prevail over the accounting standards. So if there is some inconsistency between the two, then law will prevail over the accounting standard. That is what the rules itself is mentioning. Exemption, as I said, there are no changes in what are the exemption relaxations. I am not going to go into details. However, friends, if you go through the accounting standard amendment rules 2021, what they have done is that wherever the whole accounting standard itself is not made mandatory, okay, like for example, you take AS3 cash flow statement, then you know that even if you may fulfill SMC criteria, but there is another definition under what is the financial statement, and if you see on cash flow statement is otherwise mandatory unless you are a small company. Okay, so even if you are SMC under accounting standard, but however if you are not a small company under the Companies Act, still AS3 will apply, right? So you have to then, as far as the AS3 is concerned, you have to also comply with the definition of the financial statement under the Companies Act, okay, because that financial statement definition covers cash flow statement also, and only one person company and small company are exempted. So you have to be careful that you may be SMC under the accounting standard rules. However, if you are not a small company, then cash flow statement will be applicable. So wherever that I will take another example, AS17, suppose segment reporting, it is not mandatory for SMC. So wherever that whole standard is not applicable to SMC, no, then in the beginning of the standard itself, it has been mentioned under the accounting standard rules 2021 that AS17 is not mandatory for SMC. However, standard is applicable, okay, but there are relaxations given for any measurement kind of things or any specific disclosures. Then where they have placed this, that for SMC so and so things are relaxations, or there is exemption from this disclosure. So after that particular para, they have said that para number so and so up to from so and so para to so and so para, if you are SMC, then you have a relaxation in the disclosure, or you have relaxation as far as the measurement is concerned. So if you take AS 15 employee benefits, there will be so many paras where they have given this relaxations to the SMC companies. So after those paras are there now, in that standard, they have mentioned one specific para they have put, where they have said that if you are SMC, then the above paras are disclosure requirements are not applicable. So this is how they have done. Okay. So like so we have AS3, we have AS15 segment reporting, then AS19 leases. There are disclosure exemptions for finance lease and operating lease for lessor as well as lessee. AS20 earnings per share. Diluted EPS is not mandatory for SMC. AS28 impairment of assets. Measurement, no need to use DCF method for calculating value in use. Okay. So instead of that complicated DCF method, management can arrive at some estimate that okay, based on our estimate, this is the value in use as far as the assets of the company are concerned, and that's why for comparability of recoverable amount, whether impairment applies or not. So that relaxations are given for SMC kind of company. Same way AS29 provisions, contingent liabilities and contingent assets, exemption from disclosure of movement in provision during the period. No need to give that disclosure of movement in the provision during the year. So that is a welcome relaxation. So I think friends, these are the relaxations or exemptions which are applicable to a few of the standards if you are fulfilling the criteria for SMC. But overall basis, if you are well equipped, then I would say that one should not go for the exemption. One can always opt for the full disclosure. So friends, now I'm coming to my last part, that is recent amendments in the company's audit and auditors rules 2014. So again, main part you must have covered during the last 2 days, where I think schedule 3 disclosure amendments also you covered, and CARO reporting requirements also you covered, because there also specifically in CARO, in schedule basically in schedule 3, that disclosure has come in. Same now auditor will have to report under that 143 also. That's what we will be covering today. Okay, so there are that clause E which they have inserted, which is actually reporting on that disclosure which you are now required to do under schedule 3, and auditor has to specifically report on that clause. So that is one major area which is going to impact our reporting as far as March 22 balance sheet is concerned. Okay, so without wasting time, let us go into the details. So there is rule 11 of the company's audit and auditors rules 2014, where the government has notified by notification dated 25th March 21, they have made amendments made to the rule 11. So if you see, look at rule 11, friends. Let me actually go through that itself. Yeah. So what is that rule 11, friends? That is relating to other matters to be included in the auditor's report. So we all know that what are the matters we were covering, actually A, B, C, D. Okay, so let me read that for the benefit of all. The auditor's report shall also include their views and comments on the following matters, namely A, whether the company has disclosed the impact, if any, of pending litigations on its financial position in its financial statements. I think this we are used to reporting every year. B, whether the company has made provision as required under any law or accounting standards for material foreseeable losses, if any, on long-term contracts including derivative contracts. I think this also we are reporting every year. C part, under that rule 11 comes whether there has been any delay in transferring amounts required to be transferred to the investor education and protection fund by the company. This also we were reporting, and there was clause D. Actually, this has come during the time of that demonetization, and for that particular period they had inserted this clause which read as whether the company had provided requisite disclosures in its financial statements as to holdings as well as dealings in the specified bank notes during the period from 8 November 2016 to 30th December 2016, and if so, whether these are in accordance with the books of accounts maintained by the company. I think this was specific clause inserted under Rule 11 for that particular period, but it still remained as a part of our reporting required, even though it was not actually relevant. So what they have done now with these amendments in the company's audit and auditors rules, they have deleted this clause D under Rule 11. So now no more this clause is applicable on that specified notes. So they have deleted clause D and inserted 3 new clauses: clause E, clause F, and clause G. Clause G, actually this is relating to that audit trail which they have deferred by 1 year, so it will be applicable, our reporting requirement will be applicable from next year. So when we report for March 23, that time we will have to report on that specifically, but for the benefit of all, I will read that whether the company in respect of financial years commencing on or after the first day of April 22 has used such accounting software for maintaining its books of account which has a feature of recording audit trail bracket edit log facility, and the same has been operated throughout the year for all transactions recorded in the software, and the audit trail feature has not been tampered with, and the audit trail has been preserved by the company as per the statutory requirements for record retention. So these are actually, so we are required to actually report on maybe 3 or 4 kinds of thing in that one area. One is that recording of audit trail facility is there or not. Second thing, the same has been operated throughout the year or not for all transactions recorded in the software. Third, the audit trail feature has not been tampered with, and the fourth, audit trail has been preserved by the company as per the statutory requirement for. So I think in the one single clause, actually we are reporting for 4 specified areas which revolves around the audit trail. So it is not just one, we are reporting on 4 assurance areas, friends. So that's why I'm saying it is wide ranging if impact, and we will have to wait for our institute for the guidance, and I am sure, I think in very near future the institute will come up with the guidance. So this was clause G, which next year it will come. So now remains what? Clause E and clause F. Okay, so ABC we already used to report. D they have deleted. G they have brought in but deferred by 1 year. So now for March 22 we are required to report on additional 2 clauses, that is clause E and clause F, to be in a nutshell. So now specifically let us see what are those. Clause E. So clause E, actually there are sub clauses 1, 2 and 3. Okay, within that clause E. So what is that? How it reads? Whether the management has represented that to the best of its knowledge and belief, other than as disclosed in the notes to the account, no funds have been advanced or loaned or invested either from borrowed funds or share premium or any other source or kind of funds by the company to or in any other person or entity, including foreign entities, it means intermediaries, with the understanding, whether recorded in writing or otherwise, that the intermediary shall, whether directly or indirectly, lend or invest in other persons or entities identified in any manner whatsoever by or on behalf of the company, means the funding party, ultimate beneficiary, or to provide any guarantee, security or the like on behalf of the ultimate beneficiaries. So I think friends, this reporting, that as far as E1 is concerned, that is from the point of view of the company who has actually invested the funds, okay, to the intermediary. So it is not the receiving party, it is the investing party, the initial party जहां से वो शुरू होता है. So उसके बुक्स में रिपोर्टिंग आएगा. Okay, so that is part 1. If you go to E2, that is the बीच में वाला intermediary parties. Okay, जिन्होंने the party who have received the funds from the lending party with the instruction from the lending party that this fund you have to further lend or invest to the ultimate beneficiary. So you are actually intermediary, you are actually conduit, right, that the lending party is using to camouflage the identity of the ultimate beneficiary. I think this again, if you see friends, has come up because of ILFS kind of episode where they had used so many such kind of entities just to for the purpose of evergreening. Okay, so with the intention that ultimately the funds will get revolved around, come back to the other company. Okay, so that you remain in the good books and evergreening happens and there is no default prima facie on the books. Okay, so I think to curb that practice, the reporting as well as the disclosure under schedule 3 has come up to curb this practice, and if however there are there, then they can get the early signals from the audit report as well as the financials that yes, such thing has happened, so that timely action can be taken to avoid actually the erosion of the investor wealth. I think that is the whole purpose behind this. Now, so as far as we are concerned, so this was the two clause, E1 and 2. Now as an auditor, what we are supposed to do? So our role is part 3. Based on such audit procedures, the auditor has considered reasonable and appropriate in the circumstances, nothing has come to the notice that has caused them to believe that representations under subclause 1 and 2 contain any material misstatement. Okay, so actually based on the representations that the management has done, as far as part 1 is concerned, which is the entity who has actually lended the funds. Okay, that is the original entity, and if you are the auditor of that intermediary actually who has received the funds with the instruction that it has to further lend or invest in the ultimate beneficiary company. So both the management, if you are reporting to a particular, that suppose you are reporting for that receiving party, then the management would have represented. Okay, so now as an auditor, by using your audit procedure, have you come across any circumstances which makes you cause to believe that the representation with the management has done above, okay, that they have not received any fund from the other entity with the directions to actually lend it to the ultimate beneficiary other than what has been already disclosed in the notes. So if however auditor finds something that he is able to identify that no, based on whatever audit procedure I have carried out, I have found that based on movement of funds, based on cash flow statement or any other link which I could establish, I have found that yes, or maybe some written document you have found, some shareholder agreement or some specific kind of term sheet where it has been mentioned that yes, ultimately you will further lend this money to the company identified as ultimate beneficiary. if he has come across certain thing, then he has to report that yes, these are the following entities which he has found where such thing has happened, and which may have a material impact, or because of this non-disclosure there is a material misstatement in the financial statement. Unless he finds something, he will have to say that based on such audit procedure that the auditors considered reasonable and appropriate in the phenomenon, nothing has come to the notice that has caused them to believe that the represent are material misstatement. I think this is what the thing is, friends. So here important point is from where to get the guidance, because I think under the audit guidance there is no such guidance available as far as the auditing guidance note is concerned. We have already guidance note available under schedule 3, where, as I said, specifically as a part of disclosure, management also has to give the same assurance. So we have guidance available under para 8.9.14 from 14 to 1 to 3. Okay, so there I think they have tried to give that what can be covered, what cannot be covered. So there I think we can look at the guidance, but I am sure our auditing standard board is in possession with this important thing, and if not later, maybe in the next maybe 15 or 20 days some guidance should come up, because we know that this is applicable for the March ending 22. So whatever who has to report in the month of April, they will have to report on this specific clause. So guidance is required from the auditing standard board, and I am sure they will be working on this, and maybe the guidance will be available for us to report on this clause E, F as early as maybe, as I said, maybe within next 15 days. That is what my understanding goes. So friends, let us wait for that guidance. But till that time, as I said, guidance is available as far as the disclosure part is concerned under schedule 3, because the same wordings are available there. So that guidance is available in para 8.9.14. okay, so that one can go ahead and look at for the guidance till the time we receive from the auditing standard boards. So that was part that as I said, one is the that E1 is relating to the original funding party. Clause E2 is applicable if you are the auditor of the company who is receiving the fund, that is the intermediary or the conduit entity which the funding party is using to actually camouflage the identity of the ultimate beneficiary, that the ultimate receiving party. Okay, so if you are reporting for that intermediary, then for you clause E2 will apply. If you are reporting for the original lending party, then you fall under clause E1. okay, and then based on the audit procedure you will have to say whether you have come across anything which creates any doubt. Okay, so I think this is what in nutshell is the requirement, and there if you have identified, then this is the disclosure. They have said that what details you have to give about those parties, so that is available in schedule 3. That you have to give all the name, identification, registered address of the party. All disclosure are required as far as the schedule 3 is concerned. However, in the ordinary course of business, if you give advance to employees, advance to customers or supplier against provision of goods or service, then it should not be covered as a part of this disclosure, because that is what the guidance is saying. Okay, and the term with the understanding, whether recorded in writing or otherwise, shall be construed basis appropriate evidences. For example, board or shareholder resolutions, investment agreements, share purchase agreements, term sheets, etc. So it is not that anything which is out of the bounds. Something has to be there which is agreed upon, right? Otherwise, if nothing is agreed upon, then how one is going to verify? So important is that there has to be some understanding that yes, I am giving this fund with the understanding that you will be actually further invest or lend into the ultimate beneficiary. There has to be something in agreement between the two parties. Now friends, this is my last part, that is clause F. Whether the dividend declared or paid during the year by the company is in compliance with section 123 of the Act. So this is also now auditor is specifically required to report that if wherever there is a dividend declared during the period, maybe it is interim dividend or a final dividend, then whether the company has complied with section 123 of the Companies Act or not. So this is what the reporting requirement is there. So in the nutshell, I have prepared a chart which says that meaning of dividend, that is there are two types of dividend, interim and final dividend. Dividend, actually we all know it is a kind of return to the investor, okay, return on investment, that is by of dividend what the investor gets. Declaration of dividend is considered under section 123 as well as company's declaration and payment of dividend rules. As we all know, dividend can be declared out of current year's profit or out of past year's profit. And then so we are required to comply with section 123 only. Further reporting is not required, but for the purpose of completion I have given what happens to unclaimed or unpaid dividend, that section 124 is there. Then transfer to that employee protection in education and protection fund investor, that is 125 is concerned. Then what happens if there is a contravention, then we have section 127 which actually deals with the punishment. So but as far as we are concerned, our reporting is limited to section 123, means up to whether dividend is declared, then whether out of the current profit, then and out of past profits, that whether that declaration dividend rules have been complied with or not. I think that is what our audit reporting requirement is, friend. So we should restrict to that. Okay, so this is specifically, this can be, you can go through later on also. Okay, these are all, we all know this. Important is that the amount of the dividend shall be deposited in a separate bank account maintained with a scheduled bank within 5 days from the date of declaration. I think this is important. Sources of dividend we know, it can be from current year's profit or profit of any previous year. Okay. Transfer to general reserve is not mandatory, it is at the discretion of the company. And how, when there is any inadequacy or there is a loss in the current year, then how still you want to declare dividend, then you have to follow the rule 3 of the company's declaration of dividend rules. And it is purely out of free reserves, so any M2M adjustments which is unrealized gain or notional gain, so revaluation of assets has to be excluded, friends. What are the conditions? The rate of dividend shall not exceed the average of the rates at which dividend was declared by the company in immediately preceding 3 years, so that rate cannot exceed. Second condition, total amount to be drawn from such accumulated profit shall not exceed 10% of its paid up share capital and free reserves as per the audited financial statement. And whatever that 10% limit comes, first has to be utilized to set off the losses, and then whatever is left, only that can be declared as a dividend. 3, the balance of reserves after such withdrawal shall not fall below 15% of its paid up share capital as appearing the latest audited balance sheet. So friends, this will apply only if there is a, you are going to remove from the general reserve. If however, if you have a profit and loss account balance lying in your reserves, then these rules will not apply. So if you have transferred something to general reserve, and suppose you don't have anything in profit and loss account opening balance, okay, then only you have to fulfill all these conditions. However, if you have a separate profit and loss account as a part of your reserves, and there you are having free reserves available, then you have not to fulfill all these criteria. These criteria will apply if only if you have transferred to general reserve and there are no balance available in the profit and loss account, opening balance, and you have to dig out from the general reserve, then only these rules needs to be fulfilled. Okay. Important prohibition on declaration of dividend. If you are a defaulting company as far as section 73 or 74, so if you have defaulted in repayment of dividend, the repayment of any your deposits which you have borrowed, okay, or any interest or anything, then you cannot declare dividend. And if you are a section 8 company, okay, then there is a prohibition, you cannot declare dividend to the members, because your purpose of incorporation is what? Section 8 companies are meant for having a charitable object, right? So its profits are intended to be applied only in promoting the objects for which it is formed. So section 8 companies are prohibited from declaration of dividend. So I think these are the two prohibitions which we need to take care while reporting on this clause. I think this is not required, but I have still, for the benefit of everybody, I have given this chart that what are the rules as far as transfer. And last, before I conclude, I think almost we have covered. ABC Limited is facing loss in business during the financial year 21-22. In the immediately preceding 3 financial years, the company had declared dividend at the rate of 9%, 13%, and 14% respectively. The board of directors has decided to declare 15% interim dividend. Is the act of board of directors valid? So as we have seen, friends, here we have to presume that we are trying to get it from the general reserve and there is no balance available in the profit and loss account, because if profit and loss account balance is there in the opening balance, then you need not comply with these conditions. So if you are going to take out of the general reserve, then you have to see that your rate of dividend cannot exceed the average rate of dividend which you have declared for the last 3 years. So here if we take the average of 9, 13 and 14, I think it comes to 12%, right? So and the board intends to declare 15%. So I think that is not valid as far as the rules are concerned. So this is a wrong decision by the management. It will not be permitted. I think this is the conclusion, fair, and that I think this part G we have already covered first part, because this is going to happen from the next year. Okay, friends. So this was what I thought I will cover in my presentation, because these all things are going to be reported for March 22 and all are very, very important and having a far-reaching impact. Thank you. So if time permits and if you have specific issues, then we can take up.
हेलो हेलो
Yeah.
आवाज आ रहा है मेरा आपको? हेलो राजेश सर,
या बोलो भाई.
हेलो, आवाज आ रहा है ना मेरा आपको?
या
सर 2-3 क्वेश्चन है सर, मैं दे दूं सर?
हाँ बोलिए.
तो मैं इसके ये देखिए आपके सामने
I think there are no exemptions according to me. If you are fulfilling the criteria, then you have to go by that particular requirements of the standard. because there is no specific exemption to Section 8 companies. This second question, as any format for audit report or financial statement given by ICAI for March 22, it means see, as far as the financial statement is concerned, guidance note is available under Schedule 3, right? That is what the format you are asking for as far as the financial statement is concerned, correct? Now, coming to audit report, your main audit report is actually SS 700. Okay, that 700 series, so that remains. Now as far as that amendment CARO reporting is concerned, we have a guidance not available in CARO reporting, so that you can apply as far as the reporting on CARO is concerned. Now coming to your other legal requirement for which are covered other matters to be included in auditor's report, that is rule 11, which I think specifically today I covered. So friends, as I said that already auditing standard board at institute is into this, and as I said, I am expecting that maybe in next 10-15 days we will have a guidance on how to report on this particular clause E and clause F. I think I'm so wait for that. Maybe next 15 days you will have a guidance as far as the audit report is concerned. Otherwise, for CARO reporting, already you have guidance. Institute has come up with the guidance note on CARO. Follow that. Schedule 3, already guidance note is available on the format of financial statement. You have to follow guidance available in Division 1, Division 2, Division 3 of Schedule 3. So follow that. Already it is there with you. And now limited requirement is of clause E and F. And that, as I said, wait for next 15 days. That guidance will be available, so then you will be able to fulfill all the requirements as far as the presentation or reporting is concerned. Okay. In case of a demerger, order is before March but not yet listed in NSE or BSE, whether we can say the company is in the process of listing. In case of demerger, order is received before March 22 but not yet listed in NSE. So actually, see, because only that listing part is pending, correct? But already that process you have already started. Am I right? So I am not able to get it exactly what you mean to say. Not yet listed means because of the demerger you are going to get listed, or you are going to get delisted. If the answer is, question is that because of demerger you are going to list yourself, okay, then the process must have initiated much before. Then already you fulfill the criteria of in the process of listing, right? So that order is the culmination, okay, but the process must have already initiated. So then already you are into the process of listing. So not to wait for that final order. And the last question, actually, could you please elaborate more on turnover inclusion items and excluded items? See friends, as I said, turnover definition is very clear. Now point is, they have said excluding other income. So they are saying that in your financial statement, as per Schedule 3 requirement, in your P&L or face of the balance sheet, you are showing what? Turnover, right, or revenue, and then you are saying other income, and then you have a total income, okay, or total revenue. So they are saying that turnover, we all are very clear what is my turnover, okay, like inclusive, exclusive, their detailed explanation is available, what can be part of my turnover, okay, like all rebates, all my whatever taxes which I collect on behalf of the government, okay, as a agent, cannot be part of my turnover, okay. Like then we have agent principal relationship, so you have to go by AS9 as far as your if you are following under accounting standard, because that is what we will be covering, right? So you have to see that as per AS9, whether you are principal to principal, whether you are agent to principal, then your turnover will be the net, right? If you are working as an agent, then that gross turnover cannot be your turnover. Only that part commission or whatever you are earning, that becomes your turnover, right? Because you are acting as an agent. So those things you have to abide by AS9 principles. Fine. So go by that. Now coming to because this definition you are going as per the audited financial statement of immediately preceding previous year, right? So already those decisions you have taken, so follow that. Now only thing they have specifically said, for the purpose of this turnover, exclude other income. So our focus should be more on other income, right? And I think there also I have taken few of the examples, what can be other income, what can be other operating revenue, right? So other operating revenue is part of my turnover, and other income I will exclude for the purpose of this criteria. So I hope I have made it clear. So for the purpose of turnover, your guidance force comes from AS9, where principal to principal, agent to principal, whether you are collecting on behalf of government like taxes are concerned, or it is on your own behalf. I think this is how you will have to look into, friends. I hope I have clarified your doubts, and thanks again for having a patience hearing, and thanks again to the WARC Tintan Bhai for having me on this and giving me this opportunity. Thank you.
Say Rajesh, Mody ji, it was an excellent delivery on various amendments in companies' rules with regards to accounts and audit. You have very well explained and covered all important areas from in detail with regards to the small and medium companies, criteria for borrowing, then holding subsidiary relationships, resulting effect due to change in the status of SMC, non-SMC, then exemptions, relaxations to SMCs with regards to various accounting standards, rules with regards audit and auditors, then requirement and compliances with regards to declaration payment of dividend. And I'm sure that all the member participants have benefited through this, and the queries also of the members have been addressed very well instantly. And it is my pleasure to present hearty vote of thanks on behalf of Western India Regional Council of Institute of Chartered Accountants of India. Thank you once again. Thank you, sir. Thank you so much.
Thank you. Thank you. Thank you, everybody. Bye.